Welcome to our quarterly presentation here at Lucia Capital Group, where today we're going to talk about the market, the economy, and most importantly, how it may impact the thinking behind developing, designing, and managing the portfolios for our clients' bucket strategy.
But Ray, before we jump right in, let's talk about what we do here at Lucia Capital Group.
Yeah, Joe, that's a good idea. You know, we like to talk about the team here at Lucia Capital Group. And when you walk into our lobby here at San Diego, our headquarter office, to the right, you'll see our financial planning and wealth management folks where they reside. And then to the left is where our trading floor style desk is and where our asset management team resides.
So what does it mean, financial planning team? Those are the people that put together your financial strategy, your bucket strategy. Our advisors, the support staff, guys like Rick Plum, you know him better as the professor, who work with our clients day in and day out to help put together your overall asset allocation, matching your assets to your liabilities, and creating a portfolio that uses both time and diversification to help mitigate risk.
Great point, Joe. And then behind the scenes is really the team behind the team, where our asset management team designs portfolios to implement the bucket strategy. You know, we'll be introducing to you some of those members of the asset management team here today.
Those are guys like our Chief Investment Officer, Mark Scalzo, guys like Aaron Rosen, Lance Helfert, and others that are part of the asset management team that are constantly looking at the markets, including individual stocks, bonds, ETFs, mutual funds. I like to say that's the side of the office where the really smart people hang out.
Well, you know, he's teasing because I like to say, you know, all of our people are smart, and they are. And it's important to understand that it's not just the strategy itself, but the implementation of the strategy together, working on the benefit of our clients to help them meet and hopefully exceed their goals. So today we're going to have a little bit of fun, you know, and go in the studio right around the corner here, and stay tuned, and we're going to have a great time.
Enjoy.
Okay, and just like that, we're in the studio, and I'm joined with Mark Scalzo, our Chief Investment Officer, to talk about our third quarter 2017 economic and market commentary. Welcome, Mark. How are we doing, buddy?
Doing great. It's great to be here. It's been a good quarter. It's been a good year.
Yeah, well, let's just jump right into it because we don't have that much time today. But let's talk about the what's going on with the economy.
Well, I think what an amazing run we've had in the markets. I think largely related to the economic backdrop that we've seen. Really strong GDP results, stronger than we're used to. You know, better than 2.5%, 2.5% to 3% now, rather than sort of 1.5% to 2%.
Starting to feel pretty good.
Yeah, so I think we're starting to see some real positive, both current indications that the economy is doing well, unemployment, a little bit of wage growth, and then when we look forward at our forward-looking economic indicators, things like consumer confidence, we see those numbers ticking up as well. So we may really find ourselves kind of in the middle of a synchronized global recovery here, not only in the U.S., but obviously outside the U.S.
Right.
In Europe, which had been a few years behind the U.S. in terms of its changing economic activity, and sort of a recovery again in China, which is a big part of the global growth story.
So the one thing I hope to be able to communicate today is, you know, I talked about in the introduction with Joe, is the team behind the team here at Lucia, right? The asset management team, really there to support our financial advisors in helping them design their bucket strategies and implement them with investment solutions.
Yep.
And so, you know, as it relates to the economic background, you know, what are some of the things that we do here with our team, right? To work our viewpoints on the economy into our portfolio design.
Well, we have a whole way of modeling economic activity that both looks at activity in the U.S. and around the globe, and really that helps to inform how we tilt the portfolios at any time from an asset allocation standpoint for clients. So we kind of have a dynamic way of tilting the portfolios towards equities, away from equities, towards international versus U.S. stocks, towards higher duration, lower duration. And we do that in the context of a bunch of economic data that sort of points us to the highest probability places to be in the market.
Okay, well then let me cut you off there, because earlier I had a chance to sit down with Chris, who's one of our economic analysts here at Lucia, and he wanted to share with us a little bit about the economic growth cycle. So here's my short interview with Chris. All right, so I'm here with Chris, and Chris is one of the economic strategists on the team. And so Chris, when we're looking at the economy in general and trying to allocate our portfolios, we often are talking about looking at the business cycle and then the economic growth cycle within the business cycle. Can you elaborate to our audience about that?
Sure. So a business cycle is a much longer trend, and an economic growth cycle are short-term trends or short-term activity trends around that long-term business cycle.
So like when, folks are watching TV and they're talking about, well, we're in the expansion phase of the business cycle, there could be little mini ups and downs within an expansion phase?
Absolutely. So you can have economic activity accelerating if the business cycle is rising, or you can have economic activity slowly waning, but still on a rising trajectory.
Got it. And so the team takes that into account when they're designing and optimizing asset allocation models.
Absolutely.
Okay. And then so, what are some of the economic factors that you are analyzing and looking at to determine whether or not we're in a peak or a trough or somewhere in the middle?
Sure. So one indicator that we might look at, it would be manufacturing hours worked by non-supervisory personnel. So what that means is if we see hours going above 40 hours per week, one might say that there could be new sales happening.
Okay.
So we might want to position a portfolio to take advantage of that, but that's just one thing that we look at, and there's many economic indicators.
Well, that's great, because here at Lucia Capital Group, we consistently work our people over 40 hours. So back to the studio. All right, so that was my quick interview with Chris, talking about the economic growth cycle and the business cycle, Mark. And so what Chris was explaining is the business cycle is a much longer term cycle with peaks and troughs and periods of expansion and contraction. And the economic growth cycle is our process for identifying different trends within the longer term business cycle. So what are some of the things that we do with the framework around identifying where we're at and how that equates to our portfolios? You mentioned some tilting and weighting and stuff like that earlier.
That sounds pretty confusing, Ray. I think the way I think about it,
let's dial it back a little bit.
The way I think about it when we take a step back is if you think about a car moving on a highway, right? That's kind of where the economy is going over the long run, right? You're cruising along at 65 or 70 miles per hour.
I see you drive. You don't drive 65 or even 70,
right?
buddy.
So that's kind of the direction of the economy, and it's hard to change that in the short run, right? But there are periods of time where you need to accelerate, right? To maybe pass someone on the highway, or you decelerate when you see some trouble up ahead. And really that's what the short-term model is doing. That dynamic aspect to it, there are times when the economy will shift downward in the midst of an upward cycle, of a long-term positive trend. And when it shifts downward like that, we may be in a certain phase of our economic growth cycle where we say, okay, in that world, if we're shifting down, we're going to move away a little bit from equities. We may move a little bit towards U.S. equities over international. So there's certain data that tells us, okay, if the economy is downshifting and we're in this certain phase, then we're going to do certain things to tweak the portfolio on the margin to make sure that we're kind of tilting, towards the headwinds, if you will. And when there's, tilting against
the tailwind,
exactly,
right?
The tailwind, and then when we face headwinds, we dial it back a little bit. And that's really what we're trying to do when we talk about sort of this shorter term dynamic cycle that happens inside of a very long term trend.
Very neat. And so that's just part of your process for actively managing portfolios. And so you think about shifting down or up. Some of that has to do with market volatility, right? And so let's talk a little bit about market volatility. I think we recently hit an all-time low. And so what does that mean, Mark?
Well, it means that markets have been very, very calm, and that they've been, generally moving in a direction with very, very low volatility. So everyone's kind of agreeing on the same path forward, or largely on the same path forward. It's when you get those large disagreements that you get very different sort of spikes in volatility from time to time. And that's because if we have a major difference of opinion, I may make one bet in the market and you may make one that's very different. And since they're very far away, that's going to change how the actual data is distributed.
So since you were using an analogy, I just thought of one. So periods of calm, not a lot of volatility is kind of like when I'm over at my wife's family's house for Thanksgiving dinner. Everyone agrees, they're getting along, having a good time. And, periods of more volatility, it's kind of like the Lucias getting together. We're passionate Italians, we like a good fight every once in a while, right? So we're like in the...
So something's happening outwardly, the other one's happening sort of under the surface.
So let's go out to interviewed Ian, our chief economist here at Lucia Capital, and wanted to get his insight on market volatility and the VIX. Check this out. Okay, so I was able to grab Ian, our chief economist, and pull him over to the camera. And so we want to talk a little bit about VIX. I mean, we talked about it in the commentary, and Mark and I in the studio will probably elaborate a little bit more. But tell us what VIX is and why we should care.
So VIX is the most common metric people look at when they talk about volatility in the economy or in the stock market. It is the S&P 500 Volatility Index, which is really just a market-based expectation for volatility in the coming 30 days.
So volatility meaning how fast the market goes up or goes down on any given day.
Exactly, and it's the bumpiness of the ride.
And so the bumpiness of a ride, great way to put that. And so for investors that subscribe to a bucket strategy where we have short-term monies for short-term needs, some mid-term monies to replenish short-term needs in the not so distant future, and then long-term monies in what we call our long-term growth bucket, right? If you've got a 10 or 15-year time horizon for investments in the stock market, why should investors care that we care about volatility?
Volatility, it moves in trend-like fashions over long periods of time. For instance, in the financial crisis of 2008, volatility spiked very high and has been in a 9-year downward trend ever since. So one might naturally wonder, is volatility going to jump back up and bring down their growth bucket returns for the coming year? We look at it very carefully to make those sorts of assessments.
So volatility is at an all-time low.
That's
Right? So we see the stock market's going up, volatility has been going down, and there's always this kind of reversion back to the mean. So are we seeing that? Are we seeing volatility coming back in the near future? And then how are we looking at our portfolios and optimizing them to take that into consideration, if that's true?
So in the third quarter of the year, the VIX did in fact hit an all-time low. And we developed an economic model because people are starting to wonder, what is volatility going to do next? Going to go to zero? Not really for riskier assets like stocks that are based on uncertain corporate cash flows. So what we do is we develop an economic model that says, okay, from today's level, where do we expect volatility to go? And if we expect it to go up, might that have a negative consequence on their stock market investments? Therefore, we choose a mix of those stock market investments to account for the possibility of elevated volatility and to guard against it, yet at the same time not giving up expected returns.
So the key is there's lots of factors that go into designing portfolios and ultimately selecting the investments that fit inside those portfolios. And volatility is just one of those key factors. So we're going to go back to the studio now. Okay, so while I was doing that, I got back and my phone is just, it's blowing up. I've got, my family members are calling me and texting me going, I can't believe you just said that, Junior. I mean, we're passionate, we argue a lot.
A Lucia with an opinion?
I mean, come
on.
Are
you kidding me?
Yeah, they're calling to argue, right? I mean, we're passionate, we're Lucias, we're just passionate Italian people, we love it. So,
I think we have a lot of Lucia on the asset management side too.
Well, actually, everyone's a Lucia over there. We've anointed you all Lucias. So anyway, so Ian was talking about, and I asked him a question. Maybe you could further, clarify for everybody. But, as it relates to bucket 3, our long-term monies that clients set aside for the next 10 to 15 years, why should they care about, volatility in the market, right? I mean, doesn't the bucket strategy itself already kind of create the discipline around not worrying about selling when the markets are volatile?
Yes, certainly the bucket strategy has risk management built into it. But each bucket then has to be invested. And we also look at when we're investing each bucket according to that financial plan, and that's really the job of the asset management team, is to actually pick the securities and pick the mutual funds and pick the ETFs that make up that bucket. We're managing and constructing that portfolio from a risk management perspective. And that's really why you should care about volatility. Because when you think about volatility on the upside is great, right? That means
everyone's making money.
That you're doing really good, and we're seeing a lot of price movement to the upside. Hey, everybody likes that, right? But no one likes volatility to the downside, and that's what risk management's all about. And so in order for us to achieve the client's objectives through the objectives of each bucket, we have to try to manage that volatility mostly on the downside, and that's our primary concern, is to try to basically have less downside capture, if you will, when the market's down. And that's what we're trying to achieve when we construct the portfolios.
So basically, if I could kind of read into what you're saying, is if you lost hypothetically 25%, you got to make 33% to get back to just even.
It's much
right?
harder.
So
let's
on the
lose less on the downside.
Got it.
And usually you have to give up a little bit of the upside to do that. But we're willing to give up some of the upside in really good markets because we've already earned a return that's beyond the objective of the bucket. And so then we're willing to take some of that extra return, if you will, and have insurance in case the market goes down, so we can protect on the downside.
Very, very good. So, all right. Well, let's move on, Mark. In our quarterly commentary, and for those of you watching, there's a download on our website. You'll be able to read. I mean, it's got to be 10 pages of stuff if you want to get into the weeds.
Grab a few hours and a cup of coffee.
Very technical, but very, very awesome stuff. But talk about central banking and the monetary policy and what's going on there, and what do you see?
Well, certainly we've in some ways we've kind of forgotten about the Federal Reserve a little bit over the last 3 or 4 months in favor of some of the fireworks that are going on in Washington with our new administration. And so, I guess what we want to make sure that people understand is the Fed is very much still very, very important in terms of having an impact on economic activity going forward. We are coming out of a period of time where where money was very easy, as they say, meaning they're providing a lot of liquidity to the marketplace.
Right.
They started removing some of that liquidity, almost a year ago or so. Now they're actually selling off some of their balance sheet, or will be selling off, or started, I guess as of the end of the quarter, the beginning
kind of a
of
reversal
October.
Of the policy.
Right, so now they're
right?
reducing their balance sheet, having been buying all these securities. They stopped buying it, that was the first step, and now they're actually selling some of them off. These are things, this period of monetary expansion that we saw over the last 8 years has to be unwound. And it's going to take a while to unwind that, and that is sort of a science experiment that's never happened before. So what we think is, one, it's going to take them a lot longer to unwind this balance sheet that they've built over the last 8 years or so. And as they do, and because we've never seen this before, it's likely going to have effects that we can't anticipate and create more volatility in the market, especially if you consider that we're at a very, very low level of volatility to begin with.
Right. Like all-time lows.
Like all-time lows. And the work that we've done, and some of which Ian shared with you when you talked with him earlier, is that generally after very long periods of low volatility, you tend to get a reversion to the mean, meaning we tend to see periods of higher volatility for a time. So we can't know exactly when, but we do expect that to be a much higher probability going forward, especially as the Fed sort of normalizes its interest rate policy.
And so how does this translate into your work and your team's work in deciding, whether to be invested domestically here in the U.S. or having some exposure or increased exposure to non-U.S. stocks? I mean, does that come into the consideration there as well?
Boy, there's a lot of factors that will impact that. We look at on the order of almost about 100 different forward-looking economic indicators. So it's not just Fed policy. There's a lot of other things because don't forget, there's central banks all over the world that are trying to implement their own policy. In Europe, it's the European Central Bank, the ECB. They're coming off of a massive period of balance sheet expansion. They will continue to provide that liquidity at least through, I think, next September is what they recently said. And so, at that point, they're going to want to start to normalize. You've got, similar issues in places like China and around the world. You've got currencies that are sort of, interplaying and dampening some of the effects of all that. You've got economies that are growing at different rates. So there's a lot of factors to consider, and certainly monetary policy is a piece of it, and the U.S. monetary policy is a piece of it, but it's only one piece, and it's hard to say how that specifically will affect your decision versus, international versus U.S. on the equity side.
Right, and one thing that Zach was talking about earlier is the valuation of domestic stocks versus international stocks. And I know that's only one piece of the puzzle.
Sure.
But I had a chance to talk to Zach about that. So let's jump out and see what he had to say. So I tracked down Zach. He's a research analyst on the team. And, Zach, we want to talk a little bit about international markets, right? So when we look at our portfolios, one of the things we're always trying to balance out is how much the portfolio should be invested in U.S. companies versus non-U.S. companies. So what's the thinking around why international companies or stocks are relevant?
Well, there are three things that I would point to. And number one is that 90% of listed companies in the world lie outside the United States.
Okay.
The second point is 25% of GDP is in the U.S. So 75% of GDP is outside of the United States.
Okay.
And then the United States listed companies account for 50% of the total market capitalization of companies worldwide. So, you have 10% of the world's companies accounting for 50% of the world's value.
And 25% of the world's GDP.
Correct.
So said differently, 90% of the world's companies are outside of the U.S., representing 75% of the GDP and half of the value.
Correct.
So tell me about how we look at investing when it relates to understanding the value of the companies or the valuation metrics behind making the decision whether or not U.S. stocks are maybe expensive versus non-U.S. or vice versa. I mean, talk a little bit about that.
Sure.
Bud.
So one of the most common valuation metrics used is price to earnings. So the amount that you pay per share per earnings per share.
Right. So commonly referred to as a PE ratio.
Correct.
Okay.
So in the U.S., that's currently about 18.9. So you're paying $18.9 for every dollar of earnings.
Okay.
For example, take Asia. It's at 14.9. So they are cheaper than the U.S. when you look at how much you're paying per dollar of earnings.
So paying less per dollar of earnings to buy an Asian-based company versus U.S.
Correct.
Got it.
Yep, and then same thing on price to sales. So for the U.S., you're looking at 1.8. You're paying $1.80 for every dollar of sales for a company. In Asia, you're paying $1.20 for every dollar of sales for a company. So there, it's also relatively cheaper than the United States.
Interesting. So what you're saying, and we've seen this on all the news channels and stuff like that, non-U.S. companies are attractive because they just cost less to own.
Yes.
Right? But performance in non-U.S. companies really hasn't been that hot over the past 5 or 10 years or so, right? So
Correct.
Can you talk a little bit about that?
Sure. So over the last 3, 5, and 10 years, international equities have underperformed U.S. equities. But in the last year, we've seen international equities outperform U.S. equities. So what we think we're seeing is a move towards mean reversion. So they're starting to perform where we would expect them to perform, given their valuations and given how much of world growth is based outside of the U.S.
Fascinating, fascinating. So what would you say to, and I get this question every once in a while, to the investor who says, I just feel like investing in non-U.S. companies is just flat out unpatriotic?
I would answer that question with another question. Is capitalism unpatriotic?
Capitalism unpatriotic. Touche, Zach. Touche. So back to the studio, guys. Well, I think all investing is patriotic, Mark. And
Certainly here at Lucia.
Here at Lucia. So I salute to you, Zach Leeds. So moving on. I mean, we know. I mean, PEs, price to earnings, and price to sales isn't the sole indicator of determining whether or not it's a good time to invest internationally or not. But when you're building a diversified portfolio, I mean, briefly, what are the diversification benefits that investors get when you add international or non-U.S. stocks to a portfolio?
Yeah, and I think that's the important way to look at it. If you have a U.S. only equity portfolio and you add some international exposure, generally, not in every case, but generally you're reducing your overall risk, reducing your overall volatility. Why? Because markets in Japan don't behave like markets in the U.S. Markets in China don't behave like markets in the U.S. Markets in Europe don't behave, etc. So they're not all correlated with each other. The less they're correlated with each other, the bigger the benefit it's going to have in a portfolio. And so we want to include things in a portfolio up to a point. If we went all international, then we're actually going to increase our risk overall in general.
Right, so you wouldn't just put all your eggs in one basket.
Correct.
Right?
So and that's the same thing. So, we want some, perhaps we would be leaning towards having a global orientation or allocation or a global portfolio. You want some international exposure. Look at this year. This year, international stocks are outperforming. They outperformed in the third quarter. They outperformed overall year to date.
Right, and last year all we heard was, I just want U.S., I just want U.S.,
Correct.
invest me like the S&P 500.
Correct,
Right.
correct. So there's a lot of logic to including in terms of an overall strategy and a process, subject to a process, as everything is here at Lucia. There is a lot of logic to including an international exposure because it will reduce your overall risk. Now, another thing to think about in terms of non-correlated returns and reducing risk is an alternative allocation as well. And there are different ways for clients where it's appropriate here that we can provide some exposure to alternatives. And all I mean when I say alternatives is really non-traditional asset classes. So
right, and they
not
behave
equities,
different.
not bonds.
And they typically behave differently than equities and fixed income.
Correct.
And actually, go figure, I had a chance to sit down with Aaron Rosen, portfolio manager here at Lucia, in his office talking about alternative investments. Let's take a look and see what he had to say. Okay, so I've been bouncing around the asset management department today, and now I'm in Aaron Rosen's office. Aaron's a portfolio manager here at Lucia. And so Aaron, in our quarterly commentary, we talk about alternative investments, or alternatives for short. Can you tell us about the view of alternatives, listed versus non-listed? What are alternatives in the first place? Why are they important? Why should people care?
Yeah, so alternatives are really any asset class that doesn't correlate with broad stock and bond markets, right? So it's diversifying within a portfolio perspective. What you're trying to capture is a different return stream from stocks and bonds so that we've obviously seen a bull market run for a number of years in those areas. Markets are cyclical, right? And so when the opposite happens, you want to have part of your portfolio able to generate returns regardless of those markets, which adds value overall from a kind of efficient frontier perspective.
So in short, alternatives would hypothetically be zigging when everything else is zagging.
Yeah, and it could represent anything that does that, right? Real estate, private debt, REITs or BDCs, hedge funds, long-short funds, managed futures. The list just goes on. MLPs.
Right. Okay. So, and speaking of MLPs, I know the teams was talking about this divergence in MLPs performance recently with the price of oil, right? So oil's been going up,
Yep.
and the price of MLPs, which are typically invested in the energy sector, have been going down. So briefly, can you summarize what's going on there,
Yeah.
and let the audience understand that this is something that the team thinks about as part of the overall portfolio.
Yeah, so what's going on there is kind of the real question, right? And that's what we're trying to figure out as well. Historically, those two things have correlated very highly in the past. And recently there's been this divergence. And so what we need to figure out and what we kind of look to understand is why, right? Because if it's a question of, an interim lack of movement and there's kind of upside potential within MLPs as they catch up on that performance, it's a great buying opportunity. But if it's the market broadcasting that there's serious concerns about the balance sheets of those MLPs, then it's on the opposite side, right? And okay, maybe we need to steer clear of having that type of exposure represented by those because there's more potential downside than just what they kind of initially would represent.
So, and folks, and that's really the beauty behind active management. You've got a team behind the team looking at our portfolios, analyzing this kind of stuff, because oftentimes what you see on the surface, there's so much more underneath, right? So, Aaron, hey, thanks for your time.
You bet.
We're going to get back to the studio. All right, back in the studio after a nice conversation with Aaron at his desk about alternative investments. And Mark, my key takeaway from my conversation with Aaron is there's a whole nother world out there beyond just stocks and bonds called alternative investments, and they're tradable on exchanges. They may not be tradable, right? And the key part is understanding the value of what you own is really, really important, especially in alternative investments. So, Mark, how do you think about valuing the investments that we invest in here at Lucia?
I guess value can mean a lot of things, Ray. We talk about every investment having a purpose at Lucia, and every investment in our portfolio has a purpose. And part of the value of an investment is how it serves that purpose in the portfolio. So if you're investing in an alternative allocation or something that we would consider alternative non-traditional, let's say, as an investment, part of investing in that, the part of the value that it brings is that it doesn't behave like those traditional investments in different market environments. And so the fact that it has returns that are different will lower volatility, as we talked about before, that are not as highly correlated, will reduce overall volatility. And that's a major purpose for including them in a portfolio, is to reduce your risk. So it's not just about absolute return. It's not just about absolute value. It's about valuing the other characteristics of a particular investment that meet a specific purpose in your portfolio.
And that's a great point. And specifically as it relates to value investing, I actually had an opportunity to sit down with Lance recently and talk about value investing, as Lance is our value portfolio manager here at Lucia. So let's take a look at what Lance had to say when it relates to value investing in his style of a portfolio. Okay, so I'm here with Lance. Lance is a portfolio manager here at Lucia, and Lance's specialty, if you will, is value investing. So Lance, what does it mean to be a value investor?
We want to find a business that trades at a good value based on what we see out there in the market. So that might include the recurring revenue aspect of the cash flow aspect of the business. What kind of debt do they have? What kind of assets do they have? A lot of times investors don't necessarily give credit to anything other than what the brand is or what the cash flow is. But we really want to know what sort of components the balance sheet has. So if they have real estate, if they have cash on the balance sheet, if they have a lot of debt, if they have pension liabilities, we take that into account and want to make sure that we're not buying something that we're unsure of what the true liabilities of the business are. Just like somebody who owns a house. You could say the house is worth $1 million, which is true, but if there's debt and somebody has a mortgage of $800,000, the house is worth $200,000.
Right.
That's what we do when we look at equities.
Oh, interesting. So earlier I was speaking with Zach, and Zach was talking about the price earnings multiple on U.S. stocks versus non-U.S. stocks, and with the argument that investors should consider owning international stocks because on a relative basis, using PE or even also price to sales in comparison, that international stocks are relatively cheap to U.S. stocks or less costly. What you're saying is in addition to PE, price earnings multiples, you're looking at other things. Tell me a little bit more about that.
Right. We look at price to cash flow. We strip it down and say, what's the enterprise value to free cash flow? So you look at a cash flow of a business, and there might be a business that doesn't really take a lot of reinvestment back into the company, and they're just producing cash flow. There's other businesses that are growing. They take all their cash flow and put it back into the business that grow more. So we like to strip it down and say, again, what's the enterprise value? How much debt or assets are there? And then what is the free cash flow related to the true business, not necessarily the expansion part of the business. But I agree that overseas and international markets, they tend to trade at different multiples than the U.S. And right now they are cheaper. A lot of times you pay for what you get for, so you pay for what you expect to know.
Right.
And today's an environment where the same thing. There's so much uncertainty out there that people are paying for certainty, and that's why I think that the U.S. market is trading at premiums compared to international markets.
Interesting perspective. So another way to look at it is, within the U.S., right? Apples to apples comparison. A company, say that doesn't have as much free cash flow, recurring revenue. If it was the same PE multiple as a company that didn't, right? The type of companies that you'd find into your portfolio would be the ones that have the more recurring revenue.
Right. We want a business that in good times and bad times consumer will buy that product no matter what. We're not looking for something that's a fashion-based business that if everything's going well in their discretionary income, someone will buy it, because the market typically, and in this environment, doesn't pay as much for that as a company that really is producing a product or service that's a necessity.
Fantastic. So, well, hey, Lance, thank you for that, and appreciate your time as always.
Thank you, Rick.
And we'll get back to the studio. All right, so that was Lance, and Mark, Lance, he went a little further, deeper into how he goes about thinking about investing in companies beyond just, like Zach earlier talked about, PE ratios and price to sales ratios. Lance, he mentioned looking at the enterprise value of a company,
right?
And what's on the balance sheet, and what do they have a lot of liabilities, and is that cash flow recurring? Because that's going to rank higher in his opinion. And so I thought that was very interesting.
Yeah, I mean, in a sense we look for value, and really I guess value in the most simplistic form is to buy something cheaply, right? Now, not everything cheaply is something you want to buy. Not everything that's cheap is something you want to buy.
Good point.
Okay,
Good point.
as Lance pointed out in his comment. Sometimes price is a discovery mechanism of lower quality, for instance, right? But even the things that you believe are very high quality, you want to buy them as cheaply as you can. I mean, in a sense, we're all value investors. Everything we do, even if we buy a growth company or a growth stock, we want to buy that growth as cheaply as we can.
Exactly, and I know my wife is a value shopper, because if there's ever a sale, she's out there. She's out there buying.
I thought you were going to say because she married you.
Oh, touche. All right, so let's wrap this thing up. So earlier we talked to Chris about the economy and the economic growth cycle model. We talked to Ian about volatility. You talked a little bit on monetary and fiscal policy and how that fits in the equation. International versus U.S. stocks, value investing, alternative investments. I mean, let's try to boil it back down into how our portfolios are positioned today. So we help connect the dots.
Sure.
For
So
everybody watching.
Let's do that in the context of our bucket strategy by bucket. So bucket one, we're looking at income, right? We want to generate income and
short term.
Short-term income, 1 to 7 years is kind of our time horizon.
Right.
And we expect clients to be spending that down over time in a bucket one. And so we are focused there. Where I would say we're sort of middle of the road. Okay, we're not taking too much interest rate risk, but we're not trying to protect against interest rate risk dramatically, because we don't think there's going to be a accelerated rise in interest rates from here. We think it's going to be slow and gradual and telegraphed, and we don't have a need then to have a lot of quote unquote protection against rising interest rates. We have some,
Right.
but it's not an extreme sort of position, if you will. So it's kind of right down the middle of the road.
So refresher real quick. So for bucket one, you're most concerned about interest rate environment and
If
how
you're
to
invested
design
in fixed income securities,
for fixed
which is
income
largely
securities,
yes.
right? And then whether or not you should be in more of a fundamental allocation, which is basically neutral stance, right, or unconstrained, which may be a tilt towards a
little bit
period
more
of time
aggressive,
where-
a little bit more
aggressive, right?
tilted towards rising interest, towards lower interest rates, rising bond prices, right?
Yep.
So we would have a really aggressive viewpoint in an unconstrained bucket one that was saying, well, we thought interest rates were going to go much lower from here.
Right, which is not the case
That's
right
right.
now.
That's
And,
right.
and more disciplined is in a world where you believe the opposite, right?
Rates are going higher much quicker than we expect.
Right, so a more conservative tilt, if
Right.
you will. And
Right.
so, okay, and then moving on to bucket two, more of a midterm time horizon bucket, right? A 7-ish time horizon for monies to grow before needing to repurpose that money for other things.
Right, right.
The key question there is, are we in a period where we should be thinking about allocating that portfolio, which is a balanced portfolio typically?
So we'll have
more
fixed income and equities.
Yep, a combination of fixed income and stocks, equities. Should we be tilted more towards equities or neutral or more towards fixed income?
So we're going to be a little bit more aggressive there, more in the unconstrained side, right? So more equities over fixed income.
This is that tailwind effect you were talking about.
Correct.
A little bit.
And we're implementing the equity portion of the portfolio with more value oriented strategies, with more lower volatility equity strategies. So we're managing risk there as well. The bucket two, as we all know, has a little bit longer time horizon, and eventually becomes bucket one after 7 years. Right. So we want to make sure that we need to generate some capital appreciation there, some income as well sometimes, but we need to make sure that we get a little bit of growth over that 7-year period, because that's important to achieving the client's objectives. So we're going to be tilted a little bit more towards equities right now. Roughly, the guideline is 75% equities, 25% fixed income. And with rates as low as they are and expected to only rise gradually over time.
Right. It seems logical.
Yes, it makes. I hope that would make some sense.
Fantastic. And then on bucket three, which we talked a little bit about earlier when we were talking about volatility, 15 years or so, 10 to 15 year time horizon for investments in the bucket three strategies. How are we thinking about stocks that are invested in U.S. companies or international stocks? Because that's really kind of the big question around bucket three. Should we be more or less weighted
Sure.
with non-U.S. stocks?
So our most conservative would be 100% U.S. stocks, right? So we have some international exposure. We're in sort of the 30-35% range international. So that's kind of a middle of the road. It's a global portfolio. We have some international exposure because we think relative to the U.S., international markets are undervalued, and they've been underperforming for a very long period of time, until very recently. So we would want to have some international exposure. So you're really looking at more of a global portfolio. If we went more aggressive, which is not where we are today, we would have up to 65% in international.
Very good. So, and not all of our clients are invested in just these types of portfolios, right? And we've got clients that have owned mutual funds or individual stock positions for long periods of time. And I had a chance to sit down with Tom recently to talk about some of the tools that he's using with our financial advisors to help communicate with our clients risk as it relates to their individual buckets, which could be a combination of some of these portfolios and other strategies along with some other positions in their portfolio. So let's take a look at what Tom had to say real quick about managing risk within the bucket strategy. So here I am. I was able to track down Tom. Tom is a research analyst here at Lucia. And Tom, on the onset of the presentation, Joe and I were talking about the team behind the team. Our financial advisors meet with our clients and review their portfolios, but the asset management team is the team behind the team. And I'd like to talk to you a little bit about some of the tools that you're using with our financial advisors to help communicate risk in a client's portfolio. So what's going on? What type of tools now are you have access to?
Well, that's a good question. Recently, we've been using this really neat tool. It's a risk analysis software, and what we'll do is we'll have an advisor come by with client's current allocation, and we're able to run it through the software and get a risk score on the overall portfolio and the underlying assets. It ranges anywhere between 1 and 100. 1 is very low risk, and then it goes all the way up to 100 for the highest risk portfolios. And just to give you guys some relativity of where that is, we have the S&P 500, what most people see when they think of the
like when they're watching the financial shows, that you see it up there,
and
right?
That has a risk score of 78.
Okay.
And then on the other end, if you would look at sort of an aggregate bond index, we'd see a risk score of around 29 there, just to provide some relativity.
Very cool.
What we're able to do with that is we look over a client's holdings. We're able to see where risk is coming from. There's also a questionnaire that's a part of that as well, and just trying to see that a client's portfolio is in line with where their risk tolerance is and where their advisor's plan has them.
Very neat. So the risk number is kind of like the sleep number, like the sleep
Exactly,
number bed,
yeah,
right?
that's a great comparison.
Everyone's got
Yep.
a different number. You see the commercials. The spouses might like a softer bed, so their number is lower, and the spouse might have the higher number, and so everyone's number is different, right?
Exactly.
And so like within the context of a bucket strategy, it's also kind of interesting to think about. All right, well, you got a bucket 1 or a bucket 2 or a bucket 3 portfolio, or different investments that aggregate up into filling that specific bucket's needs for somebody, but it's also kind of neat to see where they are on a risk number perspective.
Exactly, and what we do is we can also break that out by bucket, and what's nice to see is the different scores for different buckets. If we have some longer term or some stock investments, we would expect those bucket 3 investments to be maybe in the 70s up until maybe the low 80s. But other assets like bucket 2, which is more intermediate term, or bucket 1, which is your shorter term, would have a much lower risk score, and that serves to just bring the overall risk score for the entire portfolio down to a much lower level than you would see if you're just looking at where my stocks are at. So.
Right, and earlier I was talking to Ian about volatility, right? And so the risk number kind of gives you some insight into volatility and the reporting capabilities. What does it help our advisors communicate to clients for that part of their portfolio?
What it does is it just sets expectations on levels of return that are probable to see in different areas of the portfolio with the different buckets. So your range of average returns is going to be much wider in your higher risk number assets, so your bucket 3, which is in line with what most people would expect. We would expect more
volatility
out of that, but that's mitigated on the other end with your bucket 1 assets are going to show a much lower range, and overall that'll give you a portfolio that's sort of in between.
Very, very cool. So you get the risk number, which figures out where you are compared to more commonly understood indexes like S&P 500, right? And then also a range of outcomes to help people get a real gut feeling about, well, am I comfortable with how my portfolio is allocated?
Exactly. It's all about where the comfort is in terms of a risk reward for a client. So it can be adjusted up or down.
Fantastic. So the advisors work with our clients. They create their overall retirement strategy using our bucket strategy approach. And then now there's other tools that we're incorporating to help further deepen the understanding of how things should be moving within the buckets. I think that's pretty cool. Thanks, Tom. So we're gonna head back into the studio. Thanks for your time. All right, so we're back in the studio, and my key takeaway from my interview with Tom is that it's great that we've been able to build up this asset management team to really help our financial advisors deliver a higher quality, a higher level of service to our clients. And the belief is that we want our financial advisors spending time with clients focused on helping them achieve their goals. And we want our asset management team focused on investment management, because as you can see, I don't want our financial advisors thinking about market volatility and VIX and the economic growth cycle, whether it be fundamental or unconstrained, or value investing or international versus U.S. I mean, obviously that's part of what they do. They understand, they communicate with your team. I know we meet regularly with them to communicate so they can help our clients understand our thinking. But financial advisors spend their time doing financial advising. And our investment management team here at Lucia spend all their time focused on investing our clients' monies. And you don't want Mark Scalzo doing bucket strategies, right?
Right.
And so, I know Mark Scalzo doesn't want to do bucket strategies. So, fantastic team behind the team helping our financial advisors doing more. And that tool that Tom was talking about has been a great service for our financial advisors and our clients to put into context where their portfolios are positioned.
I think that's one of the hardest things to explain to clients, Ray, is how to think about, how do you quantify risk? How to think about, am I taking less risk with this portfolio or more risk? And if I own a bunch of why don't I just own a bunch of mutual funds? Why don't I just own a bunch of mutual funds that have 5 stars? And that means I'm taking less risk, right? Because I've got the best things in the portfolio. And we've seen some recent
there was that article
data.
It was like last week or so recently in the Wall Street Journal about Morningstar and their star ratings, and the general gist was it kind of was shortchanging investors, at least the writer felt, and it was only looking at really a few aspects of analyzing funds, for example.
Well, I think the conclusion, and certainly Morningstar had some something to say about this on the other side.
Right,
of
they
it.
took out actually ads on the internet.
But the conclusion of this article, and they did a lot of research, and their conclusion was that if you have a 5-star fund, it isn't any more likely to outperform over the next 5 years than a 1-star fund. It may be slightly over that period of time, and so it wasn't a great predictor of future performance. And albeit, I think one of the main problems is that people look at that star rating, and in that one thing, they assume it tells them everything they need to know about that particular mutual fund.
Well, and we know what happens when you assume. So, and here, your team. We have a process. You alluded to that earlier.
Yeah.
And so, spend real quick, talk about what you do beyond just looking at just a few aspects. I mean, there's a whole system that you guys have put into place.
We have our own series of quantitative and qualitative measures that we use, up to, I think it's around 12 factors or so that we use to evaluate a mutual fund or an ETF in terms of a part of the asset allocation that we're looking to fill. Again, having a purpose, right? There's an allocation that we need to fill. We're looking for funds that meet those objectives and that have certain characteristics, and we look across these 12 factors and come up with our own quote-unquote score that we use to evaluate amongst funds. And then we do a lot of qualitative research. Wherever we can, we talk to the portfolio managers. And we're managing overall for our clients quite a bit of money. So we can, most of them we can get an entree to and have a direct conversation about how they manage money and what's changed over time, and get an additional level of comfort, if you will, about the strategy that we're investing in, and that's really helpful and important too.
And I'd like to hit on one last thing, because I thought this was really neat that I saw someone on your team. I think it might have been Zach did. Not too long ago for one of our financial advisors, and it was a client who owned some mutual funds. They have a favorite mutual fund company, and they've owned these mutual funds for a long period of time. And he was able to look at the mutual fund and actually underneath what's inside the mutual fund, and realized that there was a lot of overlap with some of the companies in there. Talk a little bit about some of that. I mean, I thought it was fascinating work that they did, and ultimately they were able to communicate that to the client and make some adjustments.
Well, I think this goes along the lines of working hand in hand with the advisors with their individual clients, and we can do that. And we can look at what they own, and we can calculate a risk score on using a tool that Tom described, for instance, to evaluate their existing portfolio. We can look at overlap in the portfolio. A lot of times, unfortunately, when we get clients coming into the firm, they don't really know what they own or why they own it. And so we can help explain sort of what they have, and then sort of what we would like them to do and how that differs. And we can sort of set that whole stage for them using the tools that we have.
And what's really neat is do that all within the constructs of our bucket strategy
Correct.
philosophy, which is fantastic. So,
And I like the bucket strategy. You kind of implied that I did.
No. I just say that, I don't see an HP 12C on Mark's desk. So, but I'll do the bucket strategies, Mark, and you do the financial analysis and stock picking, and we'll make that a good partnership.
Sounds like a fair trade.
I think it's a fair trade. So thank you so much, everyone, for tuning in to our third quarter market commentary. We look forward to doing this again next time. I thought it was fantastic. I had a lot of fun. Thanks, Mark, for sitting on the show today. And until next time, take care.